So the title of this presentation is called Turbocharging Returns. I've been very excited about today and this conference since I read in the media that the greatest breakthrough in research in Michael's living memory. And I said to myself, geez, I really need to get out from behind the computer and see what's going on in Moore Park. You can imagine how worried I was when I heard it was an hour session. So basically we have two papers. I'm going to just talk about turbocharging returns, and I'm going to take it from the point of bringing a national farm survey, or the average national person, and getting that up into the top 5 or 10%. And then Mike is going to take it on and look at maybe what the further potential is at farm level. So I put up this slide as a kind of a way of background, and this is I suppose a criticism, but it's also a fact. There is a lack of focus at farm level around planning, around business planning, about evaluating opportunities. I suppose there's reasons for that. We had 31 years of milk quotas that I suppose stagnated us and maybe killed the skill set in that zone. And I suppose I'm just making the point that we need to be able to evaluate options from a number of different strategies, whether it's profitability, return on investment, cash flow, and gearing. And I just put up this slide to kind of illustrate the fact that we don't really do any planning at farm level. And it's a little bit negative. Hopefully it's the only negative slide I have in the presentation. What this shows is the relationship, and I know we're going back and we shouldn't be talking about milk quota, but just to make the point, it's talking about the relationship between milk quota price and milk price. And, for me, the big driver here should have been the length of time left till milk quotas were gone. But it wasn't. It was milk price. So decisions are made at farm level based on current accounts. And that's something that, is something that we need to change. We need to change that strategy if we are going to be successful and be able to manage in the context of volatility. So this is a slide that goes up. Everyone puts it up. It's probably been up twice or three times already in this conference. This is, definitely Kevin Lane talked about it yesterday. The context of milk price volatility changes everything, and we need to be more focused on looking at opportunities and looking in the context of milk price going up and milk price going down as we expect into the future. So that's just a bit of background. What I want to cover 4 things, and I want to go through them, relatively, quickly. I don't want to, get stuck in the detail. But what we're going to do is we're going to just talk a little about evaluating financial performance, 1 or 2 slides. Then we'll go into the meat of it and talk a little bit about expansion strategies that we can look at from a farm point of view. Then just to mention again a couple of competing opportunities. There's always plenty of opportunities where we can invest in things that won't give us a return. And then finalise by talking about implementing the plan and what's the best way. So, probably seen this slide a number of times. Very simple. Return on capital is net profit. So the net profit that you see in your farm accounts plus interest divided by open assets. So to calculate the return on assets for any investment, we talk about net profit plus interest divided by assets. And we're talking about a target of 5% over the cost of funds. So that's when we're deciding on opportunities, we should be doing this calculation before we make any decision, whether it's around expansion or whatever it's around. Return on equity then is essentially your proportion or your cash that's going into the investment, and that's simply net profit divided by opening equity. So, how much money you put into the investment, net profit divided by that. So that's the only 2 things I want to talk about, because from a financial point of view, net profit itself, you know what that is. So, we're going to use these now as we go through the presentation in terms of looking at the different options that we take into account. So the next thing then we talk about is expansion strategies evaluated. So we're going to look at a number of expansion strategies, and by way of background to that, we're just going to talk a little bit about some of the variation that's out there in relation to grass growth, grass utilization, and what effect that has on overall profitability. So the first one, and this slide was put up yesterday, I think, and it basically shows the relationship between grass utilized per hectare and net profit per hectare. This methodology, or this calculation, is happening it's a key driver of what we do in terms of the dairy industry in Ireland, but it's also a key driver of what's happening internationally, in terms of a key driver of New Zealand. Even in Australia, it's seen as a key driver in terms of utilisation. The point I just want to make about that slide is just to say that there is huge variation in grass utilised. So you can see utilisation varying from, just over 2 tonne per hectare up to farms utilising over, close to 14 tonnes per hectare. So there is huge variation, and we need to dig into why that is in terms of the overall utilisation. The overriding point here is every extra tonne of grass that we utilise is worth €185. And one variable, grass utilised, can explain 41% of the difference in net profit. So, that is key. Increasing grass utilisation will increase net profit. And every extra tonne is worth €181 per hectare. Why is there differences in grass utilisation? Well, this is our data from Pasture Base Ireland, and you can see here that there is huge variation in terms of grass growth at farm level. We have farms on this graph, and there's a lot of numbers on that graph, but the detail isn't important. Just to say, there is farms in this that are growing 10 tonnes, and there's farms that are growing close to 18 tonnes on that slide. So there is huge variation. And if you look at the slide, and try to break it down regionally, there's no real regional effect here. So it's mainly down to management. So, we can argue that there are small regional effects, and John and myself are both from a small area in North Clare that would be one of those areas that are regionally challenged, I think, John, we could call it. So just to make the point that there is small regional effects, but vast majority of the differences here is from a management point of view. What does all that mean in terms of profitability? If we break that down and look at profitability, what this slide just basically shows is the net profit and the things that make up net profit from the National Farm Survey average farm. So in 2015, the average net margin on a National Farm Survey farm was €1,100, close to €1,200. They were utilising about 7.8 tonnes of dry matter. They were stocked at 1.93 cows per hectare. They were feeding about 900 kilos of concentrate, grazing season length of about 240 days, producing about 887 kilos of milk solids per hectare, and costs of €3, ballpark, just over €3 per kilo of milk solids, and costs as a percentage of income. So for every euro that was coming in, there was 59% going out in costs. If we look at the top and bottom 20% on top of that, well, the bottom 20% were making about €1,000 per hectare more. They were utilising about 1.5 tonnes more. They were stocked higher. They were feeding less concentrate. They had longer grazing season. They were producing more milk solids per hectare, but all that increase in milk solids was coming from grass utilised. They had costs that were 50 cents per kilo of milk solids lower, and they were keeping more of what was coming in. So cost and percentage of income was 48%. So every euro that was coming in, they were keeping 52 cents. Compare that to the bottom 20%. Net margin of €278 per hectare, or a difference of about €2,000 between the top and bottom 20%. They were utilising 6.5 tonne, so they were utilising about 1.5 tonne less than the average, or about 3 tonne less than the top 20%. They were stocked lower. They were feeding more concentrate. They had a shorter grazing season length. They were producing less milk solids per hectare. They had higher cost per kilo of milk solids, and every euro that came in, there was 81 cents going out in costs. So just to make the point that, driven by differences in grass growth, driven by differences in grass utilisation, and huge effect on net margin per hectare. Why was there those differences? Why was there those differences in terms of grass growth and in utilisation? Well, again, if we look at this slide, we start to see some of the reasons why there was differences in grass growth and grass utilisation. Again, the detail here isn't massively important, just to make the point that if we look at soil status in terms of P, in terms of K, or in terms of pH, in terms of P, and this is 2015 data for dairy farms in Ireland, there was approximately 55% of farms that were at soil index, that were less than soil index 3 from a P point of view. From a K point of view, there was about 53% of farms that were less than soil index 3. And in terms of farms that were less than 6.2 in terms of pH, it was closer to 60%. So, we start to see some of the reasons why, there is differences in grass growth, and we see some of the reasons why, there is significant variation across the farms. So, We can see there's difference in grass growth, there's differences in grass utilization, and that's having a huge effect on differences in profit. So what we want to do now is take that National Farm Survey average farm, or the national farm where it is today, and look at different options and look at what the effect of those different options are. So we're looking at a number of different options from where you are today and where you want to go. So first option is you can remain static. Needn't do anything, remain static and hold where you are. Second option is increase grass growth and keep your heifers on, right? So you can increase grass growth, keep the heifers on. How are you going to increase grass growth? Well, you're going to invest in soil fertility, you're going to invest in reseeding, you're going to increase your nitrogen fertilizer, and you're going to increase your management skills. So you have 4 different strategies to increase grass growth. Next strategy is increase grass growth. So same grass growth as the scenario before, but you get the heifers off. Move the heifers off, whether it's to an out farm or to its contract rearing. It doesn't really matter. But the heifers are gone from the milking platform. Next strategy is you expand, but you get no increase in grass growth. So just expand, all the sheep are going out the gap. Let's follow the sheep. Maybe that's what we should do. So expansion with no increase in grass growth. So next strategy then is you have a baseline, so you no increase in grass growth, but you get to rent in 20 hectares. So you get 20 hectares on the milking platform, that's available. Next strategy, you increase grass growth, heifers on, plus 20 hectares. So it's the same as the scenario before. The heifers, you're increasing the grass growth, the heifers are on, but you have an extra 20 hectares. So that extra 20 hectares is adding to the bottom line. And finally, you increase grass growth, heifers gone, and again you get to 20 hectares. So we're going to look at them different options, and we're going to look at what the effect is in terms of overall all returns. So first thing is in terms of the baseline, we took a 50 hectare farm, grown 10.3 tonnes, that's the National Farm Survey average, on 50 hectares, and the heifers are on. When we invested in soil fertility, when we invested in reseeding, when we put out more nitrogen, and when we increased our management, we assumed that grass growth goes up to 14.3. And we can maybe go into the detail on that later on if needs be. So grass growth up to 14.3 tonnes per hectare. Cow numbers to utilise all that demand increases to 124, and you still have the heifers on. When the heifers go off, your cow numbers can go up to 142, so a big increase in cow numbers. Where we expand, we get no increase in grass growth, so we're buying in a whole heap more feed. Cow numbers are at 124. And then where we can bring in additional land on the milking platform, cow numbers are at 126. Where we can get extra land into the farm, an additional 20 hectares, cow numbers can go up further. So just to make the point that as grass growth increases, cow numbers go up. As heifers go off, cow numbers go up. When we buy in additional feed, cow numbers go up. When we bring in extra rented land, cow numbers also go up. Just some of the assumptions. We assume that the investment happens over a relatively short period of time and that we have reached that 14.3 in terms of grass growth by year 5. So grass growth goes up relatively fast. We're aggressive with how we invest. All investment except livestock are depreciated over a 20-year period on owned land and 15 years on rented land. So we depreciate it over that period of time. We're assuming that we're going to borrow 70% of what we need to invest, and we always include full labour costs. So full labour costs are always included in what we do. Some of the other assumptions in terms of additional cows, and everyone here will have different assumptions in relation to what some of these investments costs are, and you'll say that some might say that they're unrealistic or that they're very realistic. But again, the point here, I suppose, is they're probably relatively close to the ballpark. If someone has serious issues with them, we can debate. So we assume that every additional cow that's in the system is costing €1,200. We assume that every additional unit in the milking parlour is costing €6,000. We assume that every additional cow accommodation on existing platforms, so we're adapting accommodation, is €600 per cow. Where we rent in the additional land and we have to build new accommodation, we talk about €1,000 per cow. And the investment to increase grassland productivity is around €1,500 per hectare. So not all the farm will have to be reseeded. Not all the farm will have to get significant amounts of P&K. But we assume that the average cost across all the farm is about €1,500 per hectare in terms of investment. Detail on this slide is not important at all, just to make the point that in the baseline, we're producing about 680 kilos of milk solids per hectare. When we expand to 14.3 and keep the heifers on, we're producing about 900 kilos per hectare. And then when we get the heifers off, that goes up to about 1,100 euros per hectare. So it's still not, off the wall performance in terms of output per hectare or anything like that. Just in terms of the investment, again, just to say that we have, I suppose, covered the different investment. In the National Farm Survey farm, we assumed that the total investment on that farm, the total capital tied up, is about 1.5 million. So just take that for a minute, that on average, every farm in the country has about 1.5 million tied up in capital. When they expand, in the first scenario, it's an increase of 165,000 euros of an investment, brings the investment to 1.7 million. Where we get the heifers off, it goes, and so on down along. So, for the final scenario where we increase to 198 cows, the total investment is somewhere around 400, just over 410,000 euros, brings us to roughly 1.9 million. So just to make the point that there are significant investments required with the expansion process. So there was a lot of numbers there, and a lot of those are, around the assumptions that we've included. So what do the overall returns mean? And what we do here is we're looking at the numbers in two ways. We're going to look at it from a net profit point of view, and net profit includes labour, right? So it includes labour. It's gone out of the system. And then we look at it if we didn't have to pay the labour, which is probably doesn't happen, but just to make the point, if we didn't have to pay the labour, what would the numbers look like? So the first scenario, we expand, milk price 29.5 cents a litre. In the base scenario, on average, this farm was making 37,000 euros on profit. When they expand and keep the heifers on, profit is somewhere around 57,000 euros. When the heifers go off, profit goes up to about 65,000 euros, right? So significant gains in terms of profit. Where we expand and we bring in the additional feed, where there's no increase in growth, there's a significant reduction in profit, goes from about 38,000 down to less than 30,000 euros in terms of profit. So profit drops when the feed isn't generated from within the platform. Even expansion, and this one kind of surprised us a little bit, where you don't get any increase in grass growth and you rent in additional land, it's still a lot better than buying in the additional feed. So even if you don't invest in soil fertility, increase grass growth, expansion through bringing in land is a lot better than buying in feed. And then where we rent in land, there is substantial gains in terms of profit. So where do we end? Where we've gone from 90 cows starting to 198 cows, and you can see profit has gone from about 36,000 euros up to about 90,000 euros. So a substantial increase in profit with full labour costs gone. If we didn't have to pay for any of the labour, if it was all free, which obviously is not the case, you can see that, instead of generating, the base farm generating 36 or 7,000 euros, that farm is generating somewhere around 66,000 euros. And in scenario 6, where the grass is increased and heifers are off, and we rent additional hectares, profit goes to, somewhere around 148,000 euros. So you can see here that there's a significant labour cost. One interesting point. So in this scenario here, in the base scenario, we're generating somewhere around 65,000 euros in that base National Farm Survey average situation. If we expand by bringing in additional feed, and we don't count the additional labour costs, right, which is sometimes what happens when we talk about I'm making more money out of expansion by bringing in additional feed. If we forget about the labour cost, there is slight an advantage. So what's happening here? You're running a lot harder, you're working a lot harder, and you're making a very, very small gain in terms of the increases in profit. So just important to make that point that, if we don't count some of the costs, we will come up with a different answer to if we do count some of the costs. And that maybe is justification for some, individuals or some groups justify increasing output through bought-in feed. So that's profit. What about return on capital? And this is the additional capital. This is only the additional capital that's invested on the farm. So the first, again, so we have the same slide again, and we're going to look at return on capital. We said a good return on capital would be 5% over cost of funds. I hear there was a good debate about banking stuff yesterday, so I suppose we're all clear, cost of funds are whatever they are, but so we'll say cost of funds are 4.5%. So 5% over cost of funds will be 9.5% return, will be 9.5%, 10% will be good return. So in scenario 1, where we invest, we fix soil fertility, we increase grass growth, we're getting a return of 14% when we keep heifers on. When we take heifers off, that return goes up to 16%, right? So substantial return, way over what we would deem as a good investment at farm level. If we invest in bought-in feed, profit reduces, so there's actually a negative return on investment. So that's an absolute no-no. Now, when we rent in additional land, it probably makes sense that there's an extra cost coming with that land, so the return on investment isn't as good as it is where we're just increasing productivity on our own farms. So the return is somewhere around 11% where we just increase land area. It's somewhere around 13% where we increase grass growth and keep the heifers on, and somewhere around 14.2, 14.3 where we take the heifers off. So just to make the point that when you're renting in the additional land, your gain is, in terms of return on capital for that additional capital, is slightly less, but you're investing more capital, so your overall return is higher. So when we look at it on an overall basis, first thing to show is that in the base scenario, we're getting a return of 2.7% nationally. That's the National Farm Survey average. Figure is somewhere around 2.7, 2.8% is the average return that we're getting for the capital we've invested. I said a minute ago the good return would be somewhere around 10%. In scenario 1, so by investing in increasing grass productivity and keeping the heifers on, we can increase that return to somewhere around 3.8%. Where we get the heifers off, that goes up to about 4.3%. When we expand without investing in grass productivity, our return reduces. So we've reduced the overall return on our capital on the overall farm. Where we invest in bring in additional land, we're actually increasing the overall return. So just to compare the point there, in the last scenario where we increase grass growth, rent in an additional 20 hectares, we're actually doubling the overall return on the farm. So it's going from 2.7 up to about 5.3, 5.4. So by investing in increased grass productivity and then bringing in the additional land, we can actually double the return on investment for the overall farm, which is a very positive outcome. This slide is, it is sensitive to milk price. Obviously, I've done my analysis at 29.5 cents a litre. If you're dealing with a lower milk price, you're going to have a different set of numbers. So this is the base at 29.5. If you have a lower milk price, obviously the figures are a lot less. Just to make the point that in the base scenario, we generated about 37,000 euros. And in the scenario at about 37,000 euros at 29.5 cents a litre. Where we've expanded and increased grass productivity, we're actually generating something similar in terms of profit at 24.5 cents a litre for this scenario where we've driven grass growth and increased land area. So that's having a substantial effect on increasing the resilience of your business. You have a much more resilient business and you're in a much more stronger position to deal with reduced milk price. Obviously, when milk price goes up, we're all in the happy, happy land. Okay, just in terms of land rental cost, and when you talk about land rental, often the debate is often about not really talking about grass productivity or not really talking about the investment you need to put in. Often the discussion is about how much you have to pay for the land. And this slide tells me that's probably not the right place to start. How much you have to pay for the land probably has very little to do with the return from what you're getting from the land. So in the base scenario here, we paid 500 euros a hectare or just over 220 euros an acre. But if that was 620 euros a hectare or 370 euros a hectare, it didn't really have a huge effect on the profit generated from the farm. So just to make the point that obviously it's important, but it's not the most important thing that you have your discussion with first. Okay? Just in terms of the investment then, again, it has an effect. So how much you invest in terms of when you do the expansion has an effect on the return, has an effect on the profit, but probably not as important as again, the grass productivity effect. So it's relatively, it has an effect. For every a 20% increase or 20% reduction has roughly a 10,000 swing on the effect when we do expand. So that's just what I wanted to talk about in terms of different options and what the different options are and the returns that are given from the different options. So just in terms of some of the competing opportunities, and there's many competing opportunities that we can invest in on the farm. Most of them will give you a small or negative return. So we need to be careful in how we invest on the farm and how we evaluate it. This is a slide that a piece of work that we did last year where we compare AMS, automatic milking systems, to conventional parlour systems, and we look at the additional investment associated with AMS versus conventional systems, and just to make the point that the overall return for the additional investment is negative. Okay, so just make the point that when we do, we need to be careful in how we invest. So first one is that. So there's a competing opportunity. We can invest in soil fertility and grass productivity and get a return of 15 or 16%, or we can invest in technologies that will give us a return of less than zero. You probably guess where the rest of these are going in terms of the competing opportunities, but just the next one you could invest in is a feed-to-yield milk system. So you can invest in a lot of technology that allow you to identify cows individually, feed individually, based on record milk individually, get a response in feed-to-yield systems. And basically, when we looked at that, the return on investment was also negative. Next option we looked at is in relation to energy and energy conservation. A lot of talk about energy conservation. We won't mention Northern Ireland, but just in terms of return on investment for different, maybe they should have got us to do the analysis for them. Just in terms of the return on investment based on energy, different energy investments. So we compare Everton to a direct expansion, right? Everton is a direct compared to a direct expansion. Excuse me. And what we can see here is the only one that really makes sense to give a really, really good return is a plate cooler with direct expansion, right? Ice Bank was positive, but the return wasn't huge, and it depended on whether you were using night rate or day rate, and it was very important that you used night rate electricity for it to make sense. Excuse me. Okay, so there are many competing opportunities. We need to be able to sort the chaff from what's going to give a good return. Solar there is showing very strong results, as you can see from the slide. So finally, just implementing the plan. So putting the plan in place and how you do it. And I'm not going to go in and talk about fixing soil fertility and how you do that. But there was a good discussion on it yesterday from what I can gather. So just in terms of implementing the overall plan, and really what I want to cover here is the speed and how to expand at farm level. So you have three options. Again, you could remain static, you could expand gradual, or you could expand rapidly in terms of how you expand at farm level. Just in terms of the effect on cash flow, which is probably the big one from an expansion point of view, you can see expanding static, your real numbers are declining over time. If you expand gradually, you have a significant negative in the early years. Excuse me. So a real negative at the start, whereas if you expand more rapidly, you're going to be in a more positive position in relation to cash. So actually expanding more quickly, while you might have more debt, is more positive in terms of cash flow. Might be slightly more risky, but it is more positive. And when we look at it over a period of time, you can see that expansion rapidly also give you a higher return over the period. So just to make the point, how we expand, the faster we get there, the better. Right? The faster we get to where we're going, the better in terms of, and it might mean that you have a little bit more debt, but the overall return will be higher, and you'll actually be under less pressure, and it'll be less risky where you try to do it on a gradual basis. The second last slide, Mr. Chairman, just in terms of risk, this is a slide that, when you're in North Clare, these are things that happen fairly regularly. But just in terms of the expansion process, with increased reward from expansion, there will be increased risk. We have to accept that. More specialisation, more debt, there will be more debt. There'll be, farm productivity is an issue, and unless it just doesn't happen over magic, you need to put a plan in place. There's more investment. What we're saying is risks must be identified, and whatever they are, they'll be different for every farm, whether it's cash flow, herbage production, disease, staff, and a risk mitigation strategy put in place. A risk is only an issue if it puts the business at risk. So if you identify the risk and put a plan in place to deal with it, then it's not so much a big issue anymore. And that might be around soil fertility, it might be cash management, it might be around disease management. There are many, there's lots of different opportunities. So, to conclude, Chairman, nationally, there is significant opportunities to increase returns at farm level. There's a requirement to identify the areas that give the highest returns. So we need to have the skill sets. I just went through a couple of scenarios there. We need to have the skill sets at farm level that we can identify the best opportunities for ourselves. Increasing grass growth and utilization will give a huge return. There's an investment required. We need to put in the investment. Expansion should only be considered when accompanied by increases in grass growth and increases in milking platform area. So expansion where it comes from bought-in feed is not going to give you a significant return. And there are plenty investments out there that will give us negative returns. And I suppose that's particularly important given that we're going into a year where milk price might be a little bit better than it has been in the last 16, 18 months. So there's plenty of opportunities there where you'll get a negative return. And I suppose, once you have your destination set, the faster you get there, the better. So that'll give you the highest return and least risk. And I was thinking last night when I was messing around with these slides to figure out what example could I get that would kind of relay that to us. And the only one I could get was, particularly when we're in Cork. And
this is with the approval of the chairman.
So for our foreign guests here, this is probably the best team in the country, John?
Oh, undoubtedly.
Yeah, in terms of hurling, and just to make the point that they were a very young team in 2013. They won, they stole in All Ireland, and they've gone nowhere since. So the faster you get to your destination, the better. If we didn't get there in 2013, I don't think we would have ever got there.
No.
So if there's one message from this presentation for me, based on the scenarios we looked at, if you haven't a soil test done in the last, go home and do soil tests. Fix your soil fertility, invest. It's a good opportunity. Soil, fertilizer price has probably been as low as it has been in a long time. Invest in soil fertility. That's going to give you a huge return at farm level. Thank you very much.
Super. Thank you. We'll take some questions, so get your hands up for the badminton players. And the badminton players, can you start moving? Yeah. Lawrence, just while we're waiting, does it matter what way you take in that extra feed, whether you take it in as maize silage or beet pulp or whatever, does that matter? And get your hands up and we'll get you a badminton player. Super. Yeah.
So, John, I looked at it coming in as forage in terms of silage, coming in at €170 per tonne of dry matter as fed. And that's probably as good as it's going to be got, right? Where you look at it, when you do it where you bring it in as fodder beet or something, you might get a production response, but to be relatively small, and then you're complicating your system. So I'd argue that it probably wouldn't have a huge effect on the overall return in terms of whether you bring it in as concentrate or as forage.
And 170 seems very fair.
Chairman, on financial management, to measure the kilo or the kilo of solids. Sorry, I'm after losing my tractor. 1 second.
You're okay.
Say per hectare or margin per kilo of solids. Do they add up to the same thing, or should we focus solely on solids?
So for me, the answer should be related to, I suppose, what's the most limiting factor on your farm. So if it's land, that's the unit of measurement that's restricting you, and that's how you should benchmark yourself. So if land is your restriction, and probably is for most people, it's per hectare is your number. Where land is the restriction, definitely per kilo milk solids is probably the way to go. I know that we have been slow to move in that direction as an industry to talk about solids. Okay, as an industry, we're paying for milk on A plus B minus C since 2006-07, but we have been slow to communicate it, and that's partly our fault, I think. So definitely we should be looking at it per kilo milk solids. And your final point, when you add up kilos of milk solids, margin per kilo milk solids or costs per kilo milk solids, they will add up to on a per hectare basis if you multiply them up.
Yeah, Kevin.
Laurence, you mentioned at the very start a current account in surplus for a dairy farm can be a dangerous thing. So given that 2017 is forecast for a reasonably good price. How or what advice would you give to reasonably good farmers, maybe stocked at 3 cows to the hectare, and feeling the need to expand for expansion's sake, and what investment criteria or what advice would you give to that farmer?
So for me, Kevin, and those farmers, I'm not so sure that they all have a good handle on their soil fertility. So what I would do is I'd tell those farmers today, this evening, tomorrow, go out and do soil tests. Because it's the one thing that they can invest in this year. If milk price is good, that's going to give them a very good return, right? That's the first thing. Second thing I would do is look and, be more critical around the opportunities that you evaluate. So there will and is many opportunities. Robert talked there a minute ago about opportunities that came to him. There will many opportunities come. So it's a case of doing a plan for it. And for me, it should have, the plan should include the investment requirement, and it should include a set of numbers across the period and look at the return from that plan. And don't make the investment unless you can get a return that's, that you're comfortable with, and people will be different. Some people will want a return of, 12, 14% on their investment. Others will be happy with 8 or 9. But once you know your numbers, once you know what the investment will give you, you can be very clear about the decisions you make.
But is there a danger, though, that farmers will push stocking rates and maybe not so much expand the land, but actually expand in a different way?
Yeah, and that, for me, these numbers tell us that the trick for me is if you do your numbers, you won't make that mistake. And if you have your plan done, that's not going to happen. And this analysis for me tells me that if you drive the numbers too hard in terms of what the farm can carry and the versus the feed that needs to come in, you're at nothing. You're actually the tip. I often thought about running faster to stand still. What did that mean? And when I put that slide together, it was absolutely clinical. You're running an awful lot faster, you're milking a lot more cows, but you're actually going backwards. So it's a big danger, and maybe we've been a little bit lucky in the last 18 months that, milk price wasn't off the wall and we hadn't made stupid decisions, but I think we need to be clinical about the decisions we make from now on.
Yeah. One other question, and Michael, you might be making your way because I know it'll take you a while to get from here to the podium. But come here, it's getting very, there's lovely zero grazer yolks, and they're mighty. Like, why can't we invest in them? And I'll take that question, don't even answer that. Because I know the answer myself, for once. Question down the back.
I've got a question about just including all labour costs, including a nominal figure for family labour as well, and why do you bother to separate that out at all?
Because, so why separate out family labour? Why put a figure in? Because if you don't put a figure in for yourself first, and you should be the first person to be paid, if you don't put a figure in for yourself, you might come up with the wrong conclusion. The example I put up there is, if we don't put in a labour figure, we'll say, at all, what you'll have is, you'll have a situation where actually, putting in all that extra feed actually mightn't look like it's terribly wrong, even though you're working an awful lot harder and there's an awful lot more labour in the system. Yeah. So by putting in the labour, you're getting a very clean picture of the returns from the different ventures.
But that's exactly my point. Why do we even talk about it? It just should be part of the overall costs.
Yeah. Agree.
Yeah, and I 100% agree. I separated it out here. So in all the analysis we do, labour is included as a full cost. And that's why I separated it out here, to kind of tease out the point that maybe that's why how some people justify a different system.
Okay, we'll cut it. It's always cut it when it's going good. We'll have a chance to come back in the end again on Laurence. Michael.